All right, we just got the latest numbers on inflation, and, well, it's cooling down. Now, that should be simple good news, right? But the Federal Reserve, they're sending some signals that are honestly pretty confusing. So today, we're going to unpack this whole economic puzzle. We'll look at the surprising data, the Fed's kind of contradictory response, and what this all could mean for, all of us. So here's the big number everyone is talking about: 2.7%. That is the new annual inflation rate from the latest Consumer Price Index report. And let me tell you, this number really caught a lot of economists completely by surprise. And we're not talking about a small miss here. This was a huge deviation from what everyone was expecting. See the forecasts? They actually predicted inflation would go up to 3.1%. Instead, it went the other way. It dropped, completely defying all the predictions. Okay, so let's break that number down a little bit. That 2.7% figure, that's what we call headline inflation. But there's another number that economists watch really closely, and that's core inflation. That one came in just a little lower at 2.6%. Now, why does core matter? Well, it strips out the prices of food and energy because, those can go up and down like a yo-yo. So core inflation gives us a much clearer picture of the real underlying trend.
And this is a really important point to get your head around. When you hear that inflation is 2.7%, it doesn't mean prices are actually dropping. Think of it like you're driving a car. You're still moving forward, but you've just eased your foot off the gas a bit. So prices are still going up, they're just not climbing as fast as they were before.
And that brings us to the bigger, long-term challenge here. Yeah, it's great that things are cooling off a bit, but inflation has been just so stubbornly sticky. And by sticky, I mean it's been really, really hard to get it back down. In fact, for 5 years in a row now, it's stayed above the Federal Reserve's official target of 2%. So you'd think, right? Inflation is still too high, so the Federal Reserve must be hitting the brakes hard to fight it. But this is where the story starts to get kind of weird, because what the Fed's been doing lately seems to completely contradict that goal. I mean, check this out. On one side, you have the Fed's official goal: get inflation down to 2%. But on the other side, even with inflation way above that target, what are they doing? They've been cutting interest rates, and they've started expanding the money supply again. Both of those things are things you do to increase inflation, not fight it. It's confusing. And we're not talking about a tiny tweak here. On December 12th, the Fed started pumping an extra $40 billion a month into the system. It's a move that has some critics saying they've basically just turned the money printers back on. So what's the Fed's logic here? How do they explain this? Well, the Fed chair, Jerome Powell, he's pinning the blame for the high inflation we saw in 2025 on tariffs. He's calling it a one-time price increase. The subtext there is that he thinks this is just a temporary blip and that things will get better in 2026. Okay, so how are the financial markets taking all these mixed signals from the Fed? Let's take a look at what the pros are predicting when it comes to the future of interest rates. Usually when you get good news on inflation like this, you'd see the odds of an interest rate cut just shoot through the roof. But look at this. The chances of a cut at the very next meeting, they barely budged. It seems like the market just isn't buying what the Fed is selling. There is some deep skepticism out there about what's going to happen next. And you know what? That skepticism from the market is actually reflected in the Fed's own forecast. They're being super cautious. Right now, they're only projecting one single quarter-point rate cut for the entire year of 2026. But, and this is a big but, there's a huge wild card here that makes that forecast really uncertain. The leadership at the Federal Reserve is about to change, and that brings a pretty significant political element right into the middle of this whole economic equation. Yep, Fed Chair Jerome Powell's term is up in May 2026. A new appointment is coming, and soon. And why is this so critical? Because pretty much everyone expects that any new chair nominated by the current administration is going to want to lower interest rates to get the economy going. And if you look at the top 3 people in the running, you see a really clear pattern. Christopher Waller, who's already a Fed governor, he wants to cut rates by a full %. Kevin Hassett, who's seen as the frontrunner, and Kevin Warsh, a former governor, yep, they both want to lower rates too. Now, the leading candidate, Kevin Hassett, he's the one pushing for the biggest, most aggressive rate cuts, but his name is definitely stirring up some controversy. The big concern is that his appointment could really threaten the Fed's independence. In other words, its decisions might start being driven by short-term political wins instead of long-term economic health.
So all of this, the data, the policy, the politics, it's all tangled up. And it brings us to an even bigger, more fundamental question. A question that makes us look back at the very inflation data we started this whole conversation with. Okay, so remember that official inflation number, 2.7%. But at the exact same time, the money supply is growing at a rate of 6%. And for a lot of economists, those two numbers, they just don't compute. They don't add up. And it raises some serious questions about what is really going on behind the scenes. So critics have a theory about this disconnect. They argue that the government actually has a pretty big financial reason to report a lower inflation number than what's really happening. Why would they do that? Well, think about huge government programs like Social Security, which goes out to 70 million Americans. The annual payment increases are tied directly to that official inflation number. So if you report a lower inflation rate, you pay out less money, and that saves the government a ton of cash. And all of this leaves us with the million-dollar question, really, the one at the very heart of this whole debate. With all these conflicting signals from policymakers and a big political shift on the horizon, can we trust that the official data is really telling us what's happening to our cost of living? And more importantly, what does that uncertainty mean for the future of the economy?